This interview was conducted on February 15, 2021 via Zoom video. You are listening to Severin Sorensen, Executive Coach and Curator of the Arete Coach Podcast, where we explore excellence in the art and science of executive coaching. So I'm speaking today with guest coach Jim Lindell, who's a CPA, CSP, CGMA, and an MBA. Jim is an executive coach, a Vistage Chair of 19 years, and a best-selling author. He most recently published a book with Wiley and the AICPA called The Controller as Business Manager, and I highly recommend this book. It is definitely one on my bookshelf. He's also the owner of Thorsten Consulting Group from Wisconsin. Jim is a certified speaking professional with the National Speakers Association. Jim is also this CPA who earned his MBA and Bachelor of Science in Accounting at the University of Wisconsin. Now, I first met Jim when I traveled to Wisconsin to speak to his Vistage group, and I grew a great respect for him and how he managed his group and coaching practice. We had shared multiple conversations, and ever since, he and I have become great friends. I had him come to Utah and speak to my groups and to work with them to better understand the numbers of business and how to interpret and use them. So we drop in here on a discussion with Jim where we talk about this very thing and about the numbers of business and what CEOs know.
Okay, but what is the definition of working capital? How many CEOs out of 16 do you think got that right?
In a group of mixed experience, probably 30%.
Zero. And
oh, wow.
And then when I saw that, I said, I found something here that I have to follow up on. And then I figured somewhere about 350 CEOs within Vistage, then I have asked that same question. Guess how many have gotten it right? And I mean the correct definition. What would you guess?
The correct definition, probably less than 10%.
Only 2 out of the 300 plus. And I found out after the fact they were CPAs that had moved up into the CEO chair. So what dawned on me, and some of them had pretty good ideas, well, it's enough cash to operate your business. So they had some good stuff in there, but I realized that people didn't understand the key components, whether it be AR, inventory, extending accounts payable. And I thought, this is fascinating. You got all of these people and they really don't understand it. And yet you've had a whole bunch of people like me, CPAs, come up to them, whether it's your CFO in a board meeting, a management meeting, or your CPA firm coming in and saying, here's your financial statements, let's talk about it. And somebody, said, hey, your working capital is inadequate. And you also know then that the CEO probably did this. Oh yeah, that makes pretty much sense. And they don't have a clue what they're talking about.
Peter Drucker once crafted a humorous double entendre of great importance to business leaders. The days of the intuitive manager are numbered. Jim Lindell has provided this important book, the means and method and mind share that can allow business owners to operate their businesses tracking and using numbers that really do matter. So is it any wonder then that I thought today speaking with Jim would be a great addition to the Arete Coach Podcast, where we seek to explore excellence in the art and science of coaching today? You're the first person I've had on here that had such an extensive financial background. So you've got both an undergraduate degree in accounting, you've got the MBA, but you've been a CFO, a VP of finance, a controller, you've got your CPA, and you keep it current. So that's more education. So can you tell us about your experience on the finance side today and how that helps you as a coach?
And what's really kind of interesting is I'm a believer in the personality profiles. So when I grew up, there wasn't all this great thought of what you should be when you're going to, get a job. You listen to what your parents said. And, I can remember my dad telling me that I kind of looked like an accountant. So, there wasn't a lot of great thought about how you went through the process. And why that's important is if you believe in something like Myers-Briggs, the traditional accounting profile is an ISTJ, and I am an ENFP. I am the opposite of what an accountant is. So when I look back at my professional accounting career and look at the mistakes and hurdles that I had, typically they were tied to who I was as a person as opposed to any of the actual accounting skills. But where it helps me right now in the coaching is it is so easy for me to see companies that are having trouble. It's you and I will talk about Z-score later, but it's a metric. It's I can use the foundation so that I can recognize very fast if the company is showing signs of trouble. If I'd like to use the term wobbling in my speeches, is the company wobbling, going back and forth, and you can see something that's indicative of another problem. I'm just using the metric to help me identify it. So I use it there, and then I use it with my members. Although I try not, and you probably do this as well, as the coach, I'm trying to help them find resources. And it's not necessarily that I take them and say, oh, that's a financial thing. Hey, come and see me, I'll help you with that. So I really try to get people connected with other people.
Well, it is important to be able to refer people to others. And it is also important to have the understanding to help know when the train is going off of the tracks, how to guide them. Look, you might want to look at this more closely so that can be really insightful. I'm sure it's been beneficial to your coaching clients.
Yes.
Now, here's a question. I place, so outside of this, I have an executive search firm, and I place people, and I place a good number of CFOs in position. And here's one of my favorite questions I lead off with.
Okay.
What is the difference between a controller and a CFO, in your opinion?
I think the controller takes care of the inside of the house, transactions, financial statements, internal controls, et cetera. And someone that's a good CFO is looking at the outside of the business. They're trying to understand. You've done SWOT analysis. I also like the pestle analysis and the trends. I think a good CFO, the compliment that they receive is that they are a really good business person. So the CFO must be a business person first, and then use everything else that they've learned throughout their accounting tutelage and finance tutelage to help the company grow or survive, depending on where they're at. So I think it's internal versus external, and I want the person to be focusing on what makes the business go. I don't care about the numbers. The numbers are nothing but a translation of the activity. So you can tell me how many people, you can tell me the revenue you generate from your executive search, and you can tell me the number of people you place. But what's more important is the people that you place as opposed to the revenue, because that's all the revenue does. It translates one. And too many people get lost in, well, we got to grow revenue by 20%. We hit inflation coming up, which I do think is a key possibility going forward. And the inflation numbers will distort your total operations. And yet someone will say, oh, we grew by 10%. Great, inflation was 20. Congratulations. You're moving fine in your business. Go ahead.
There'll be a need, and there'll be those who are wise who will listen to advise their coaching clients. There will be a need to adjust your compensation plans such that we're not paying bonuses for inflation. In other words, you hit your sales marks by total number. Well, how about it in total units sold? In other words, you might want to think now proactively about the health of the business and not let inflation come and be that wrecking ball inside your company.
Absolutely.
So I want to go back to your thing. So you gave a great answer to that question.
Did I pass?
You passed. You're hired. Okay. So when I asked the question, it's interesting to me how many people kind of stumble over the difference. They're like, well, I'm a controller now, so the next step is a CFO. And I'm like, look, they are different skill sets. So let me try to describe this in a sports metaphor. Think of John Madden. So the statistician is the controller that can tell you all of the stats that an individual player has, but that doesn't tell you what play to run. The person who does the color analysis, that understands how the X's and O's move and the environment and the weather and the wind and the temperature and all of the things that are there and understands the data, that's the CFO. And just as you described, in-house, out of house, but both are vitally important. The other thing I would say, CFO, absolutely critical. You said they have to understand the people. I'm going to add one more variable. They must be personable.
Yes.
The CFO must talk to the banker. The CFO talks to the street. The CFO does the round when you're raising capital. They must have high I, or the ability to act with influencing and help other people, realizing that that's a competency they need to be successful.
And I know this isn't an accounting discussion per se, but back 20 years ago when we were doing the continuing education for CPAs, the associations were getting tired of soft skills training. Oh, we don't, you need to talk about journal entries, financial statements. And right now, there are so many young people coming out that do not have the communication skills. My joke is, if I had a course that was how to read financial statements and hug people, it would be a bestseller. And your personable comment is spot on. They have to be able to deal with all types of situations if they're going to be successful.
Yeah, that is so true. The other thing I find interesting while we're on this controller topic, so many people changing positions. It has been the case, for me at least, that the controller is the most short-lived, open, available candidate position there is, because a controller can be a controller. They could be a financial controller, a project controller, a plant manager. They could move up to CFO. There are so many needs that are there for controller that great talent that's in front of you is going to be pulled apart. And for 2018 and early part of 19, the shelf life of a good controller in our search, 5 days. Can you imagine 5 days? When they came into your pool, you had less than 5 days to vet them and to determine who they were. Elsewise, let's say your program took 3 weeks or a month. You go back and you'd say, oh, and they go, sorry, I already got another job. And you're left with the dregs. That the operating tempo of learning to hire more quickly and understand what to do is so important. So anyway, I digress. We could talk on this further, but very important, the financial side. The other part of finance that is important right now increasingly is this whole notion of FP&A, the financial planning and analysis. I'm seeing this much more needed. It goes into the data. Can you just explain in a layman's term for our audience, what is FP&A?
Well, when you look at the financial planning and analysis or analytics, it's getting below the numbers to what the meaning is, which is where I think people should be going. But they haven't had the time in the past. One of the biggest problems has always been you had so many other areas to deal with. Now, as systems get more refined, people have the ability, but then what they have to do is translate what all of those different ratios, those trends, what does that mean to the business aspect? I mean, one of the great examples there is just the quality of working capital. I think is a very interesting ratio that a lot of people have never looked at. But it talks about where your accounts receivable are to your net working capital and your inventory is to your working capital. And if you measure those out and then track them over time, one of my other big recommendations is we need 10 years of information. You need to show me the trends. And when I see something like this quality of working capital, or people be maybe more familiar with the current ratio, when that trend is just going down, there is absolutely nothing that you can convince me of that you're going to do different to make that thing work. So with the FP&A, when people can start using that information and saying, here's the action that the company should take upon that, that's where I think the real benefit is.
So in 2015, you wrote a book, an important book, one that I own, by the way, and highly recommend. It's called The Controller as the Business Manager. Can you tell us why you wrote the book and what it says?
I've been professionally speaking now for also nearly 2 decades. It almost aligns with the coaching process. And I have written many courses for the American Institute of CPAs. And in this time frame, we started to see a really need for how does a controller act in a different way. You're hearing me talk about they need to be that business person. And I had a little fight with my editor because I wanted to be controller as business partner, and I lost on that one. They got lost on the word. But that's my sense, the controller or the CFO, and I work typically with companies 250 million and under, so that title can get blended. I'm just, whoever is the top financial person, they have to be a business person first. So a lot of my focus is even on the economy, which I think is so crucial where we are today. What's going to be happening? And you can tell me that you're putting in a new financial system, good for you. You're putting in a new ERP system, great. You're refining your costs, I'm happy for you, great projects. And yet, can you tell me what's going to happen in the next 3 months? Because when you start looking at it this way and you start being able to say, this is what I think is going to happen, and we could clearly be wrong. We're not crystal ball people, but when I can predict what's going to happen and then I take actions, that's when it is more successful. You'll hear 4 terms when people talk about this and they blend it with analytics. The first is diagnostic. Can you give me the financial statements? Okay. I'm sorry, first one's descriptive. That's give me the financial statements. The second one is diagnostic. Can you give me the variances? We were going to hit 100 million. We hit 90 million. Why did that happen? The predictive, which is the third stage, says, give me the cash flow forecast or the sales forecast. All of those are key. The first couple maybe to the accounting manager, the first 3 up to the controller, and the last stage is crucial. That's called the prescriptive stage. So based on everything I've heard at the first 3 stages, now can I prescribe the actions that the business should take to be successful? So in the descriptive, I lose $500,000. Diagnosis, I lost the $500,000 because company ABC is still shut down from COVID. Therefore, in the predictive, I change my cash flow forecast, my sales forecast, because I'm not going to get the revenue from them. But here's what I do. I get an overline of credit from my bank. I go after 2 major customers that have not paid up. I extend my accounts payable, and I try to be more personable as well. That's why I wrote the book. I wanted people to do that. And we still covered the basic stuff, as well as how do we move ourselves beyond that.
That's great. Well, one of the reasons that I bought the book and that I had you come out is there is, and I'm not going to say it's been around for a while, but it's not widely used by business owners. There's this notion you have in the book called the Z-score.
Yes.
And I would like you to share what it is and why it's important. And if you want to share your screen, you can do that as well.
So when you look at your screen right now, you see an image of a doctor and the patient. And I've always equated this Altman Z-score to blood pressure. So I have high blood pressure, and right now I don't have these numbers, but what I'll do when I'm speaking is I'll say I'm 160 over 120, and you'll see the people just be aghast. And I said, what should I do about that? And then people will start prescribing to me, take your medicine, see the doctor. They'll joke about getting my will in order. They'll say, practice deep breathing, do exercise. They'll joke about my waist size. But what they're really doing is they are prescribing action because of 2 numbers that they're kind of familiar with, okay? So that led to, that's the way I explain that. But Dr. Altman back in the 60s, he said, if I could take all these financial numbers, aggregate them, throw them into a regression package, maybe I can find some type of correlation, some type of relationship between all of these numbers and what happens to a company. So on your screen right now is the Altman Z-score Model 1, which is for public companies. I'll also give you private companies as well. And what the formula simply does is if you look at X1, working capital divided by total assets, X2, retained earnings over total assets, X3, EBIT over total assets, and X4, market value of equity, which is really easy to do for our public companies, not easy for us for our private companies, over our book value of debt, and lastly, sales over total assets. If the company keys in all this information into the formula that you see in the middle of your screen, then the Z equals, what it tells us is that if you have a score of 1.8 or less, your company's going bankrupt in 24 months or less. That's a great piece of information. Between 181 and 299, it's not indicative of bankruptcy, and above 3, you're not going bankrupt. But I also believe this is why no one uses the tool, Severin. What will happen is, you bring me in to one of your former Vistage members, and the person is knocking it out of the park. They're making $30 million a year. The company's just phenomenal. And then I walk in and say, hey, I've got good news for you. You're not going bankrupt. And as they laugh you out of their office, they say, This is why people don't want to use the tool, because they say, well, I'm doing good. I'm not near bankruptcy. But what I advocate is this is the blood pressure. This is the health of the organization. And I know what it means to have a Z-score of 10 or 9. No, bankruptcy is not in the picture. But when someone then starts seeing their Z-score reduce, it tells me that all those items we had in the prior slide, something's going on. And the company may not go bankrupt at all, but it's gotten weaker. And so as I look at this information, it really is simple in terms of, is the number going up or going down? And if it's going up, we get stronger. If it's going down, we go weaker. And I'll give you 2 other pieces that you can include if you would like to. There's also a Z-score model too, which is for private companies, typically your service companies. And what you'll notice, it's the same format. I just used it a little different on this page. You'll notice that there's 4 factors on this slide, where on the other slide we had 5 factors. What disappears is the market value of equity. So they said, okay, that makes no sense. So Altman's group reran the numbers, and on the bottom of the slide, they give you a different scale that makes sense. And notice the coefficients or the multipliers, those also change as well. But in this case, the 1.09 or less, you're going bankrupt in 12 months or less. Now, when I gave you the other slide and I said 24 months or less, I have seen the actual studies that gave me both the 24 months and the 12 months. I'm not making that up. Those are hard numbers that people have already researched, okay? But I can use the tool in the same way. And then there's also the Z-score model 3, which is for our private companies, but they're manufacturing models. So again, more capital intensive. And what they do is they reinsert the 4th factor into the model, and they don't use market value of equity, since that can be confusing to us. They put in the book value of equity. They, again, Altman's group redid the score. And in this case, notice the distress zone is 1.23 or under. Now, I could not find anything that says how long it takes for a company to go bankrupt under this scenario. But all that I want people to use this for is, and I believe this is my key metric. You give me any of your clients, this is what I would do. And if they got a Z-score of 10, and next month it's 9.75, and the next month it's 9.5, and then 9.25, no, they're not going bankrupt. But the company has gotten weaker. They could still make more money hand over fist than you or I could ever envision. But what's happening is they become riskier. And what you can see when you benchmark is companies get bigger and bigger. That's that dream of the larger I am, the better off we're going to be. And in fact, the larger we get, typically the more risk we insert into the company. Our margins start to decrease. We instead of selling to a mom and pop with a 35% margin, we get that large contract with Walmart, with Home Depot. And all of a sudden, it's not the 35, it's the 28. And then we tick off the moms and pops that were paying us 35, and the overall margin starts going down. So someone can grow, get really big, and again, make astronomical sums of money. But as the company gets weaker and weaker, these are the types of signs that I would like to see. Let me just give you an idea specifically for people that want to train their controllers. Here's an example of Briggs and Stratton, and that's, you think of the power engines.
Yes.
This is something that I'm including in the controller's annual update. So you're actually the first person to see this. It'll go to my editor coming up soon for the CPAs. But you'll notice, again, 2 things. I want people to do more with trends and charts. It means more. So it's a very, very good tool for people to use. And the way it's set up is I just take the 6 major factors that are out there, pop them into the spreadsheet, calculate it, and chart it out. Just go out with the monthly financial statements.
Yeah. No, that's powerful. Well, you've just defined a zombie company.
Yes.
One that's still in business, but not likely to go further without something very significant to occur.
In our warm-up, you and I talked about some items. I mentioned how CEOs did not understand the real definition of working capital. The other thing I found out, speaking to those same groups, is I would throw up all the financial statements. And when I was talking to the CEOs, I use Sears as an example, which I just love. That's a great one to look at this. And what I would do is I'd put up the Sears financial statements, and I would ask people to guess what the next revenue and loss would be. And I gave them like 2012, 13, 14. And people got the general idea. They could get, a ballpark within $1 billion, or they could see where the loss was. And it was just they were exercising the intuition, which I thought was key, that there's a problem here based on 3 years. And then what I did was I took a 10-year revenue chart and I put it up on the screen. And then I asked the CEOs, and again, it's the same, over 300 some, only 2 people disagreed with this. I said, what would you prefer to have if I'm presenting to you as your controller or CFO? Do you want me to give you the financial statements, or do you want me to give you the graph? And everybody wanted the graph. And what was so fascinating is here we are, especially with my industry, we would give people the financial statements. And if I gave you financial statements, I'd be telling you all the reasons why this is good or bad. And you wouldn't listen to me because you would take your understanding and you'd be looking at the financial statements from your prejudices and biases, trying to understand it. And we wouldn't communicate. It wouldn't happen. So I'm also advocating for people to use your two to three graphs at the top. And one graph is revenue and your margins. A second graph gives us current ratio and Z-scores. And then, the 1 or 2 other graphs can be maybe your units of measure. In your case, maybe the number of placements you have, something to that effect. And then behind that is a 3-year financial statement. Our public companies will show that, but most of our private companies do not. And you cannot do an intuitive type of process if you don't have at least the 3 years. The 2 years won't give it to you. So then I want 3 years income statements and balance sheet behind that. That could be the hard copy. That's what I hand out at the management team. And then at the very end, give me the 10 years, at least on someone's computer. We don't have to print it out, but then we can answer the questions for people. So.
That's great. Well, you answered the question I was going to ask, and that is what should be on the CFO's scorecard to help guide the business. And I love the graph you described, the key metrics. I might add a variable, what causes sales? What is that unique variable in your industry that would be a driver? But that's very helpful.
Cool.
So an interesting question. Some people out there might be coaching someone today, or perhaps somebody has a business and they're thinking, oh, I'm interested in this one because they're going to talk about finance and so on. Here's the question.
Okay.
When do you know it's time to replace your chief financial officer?
When they are falling into the penny wise, pound foolish category, when especially as a CFO, when they're not talking about the business, and yet they're talking about, X number of cents on this or that, I don't think they're being helpful. They have to be able to do that. They need to be able to get down to what are all of the details. But at the same time, it's usually something more than, we need to save a nickel here, we need to do something there. So when they're not talking about the business, I don't know that the person's going to be doing what we need for them to do from my perspective.
What do you think about this answer to that question? When do you know it's time to replace your key financial officer? The first time the thought enters your mind.
I like it, but then what I would counter with, that's probably 18 to 24 months too late.
That is exactly my experience with that thought. And that's why the moment you have this thought, that's the time to bring the auditors in, bring the consultants, look at the data, because beneath the terracotta stones, the warriors of your financial seats, is a deep problem. And when you start looking at it, you might touch it and it will vanish just like dust. Yeah. And very painful.
And I'd also add to that, if you ever have a thought, is my financial person stealing, conflict of interest, or anything at all that is unacceptable, trust your instinct. Don't make the person guilty, but say, this is significant enough that I need to talk to somebody else if I don't have the skill set to come back in and look at it. Because anytime that one also pops up, it's a good warning sign.
This is the Good News Podcast, and I will never say the name of a client of a bad news story, but I can recall visiting one of my clients one day said, for our coaching today, I've called the board, and you're going to come to the meeting today and be not as a member of the board, but you're going to just observe what our board is doing. We're like, okay, I'll roll with that.
Sure.
I was in for 15 minutes and I called with my coach's whistle, timeout. How much money are we going to make this year? And everyone looked over at the CFO. He said, we're going to lose $300,000. Now, mind you, we had 6 months left to go in the fiscal year.
Yep.
How much did we make last year? We lost $300,000. And I looked over and I said to the owners, prior to coming in here, I benchmarked your company. And based on your revenue, you should have, if you were a normal company, and by the way, you're an industry leader, but if you were a normal company, you should have between 1.8 and 2.5 million in EBITDA every year. So by this reckoning, you, the owners right here, are not receiving $2 million a year. Is that acceptable to you? And they're like, no, we want that. And I said, all right, well, I'm not a member of your board, but I recommend within 1 week, we have a workout session before the bank comes in here, because if you miss your numbers, we're going to have a problem. So we went in there. Well, after I went to the CEO, I said, we got a real problem here. I said, the fact that he knew the number in advance, that it was the same number as before, is telling me that something, as you're right close enough to the Canadian border, you'd understand this. There's something hinky about those numbers.
Yeah.
And it was years. And then suddenly they're like, I think you're right. And by the time we got in there, and by the way, we stopped looking after a while. The statute of limitations is 5 years. Just like didn't even want to know what was behind that door.
Yeah.
But the amount of money was into the millions of dollars.
Yes.
That had happened all because of not understanding the numbers and not looking. So this issue, when do you know it's time? The first time the thought enters your mind. Yep. And this is a great time to go to your peer group, to go to your coach, to bring an advisor, because so much recklessness can happen in this one key position. Just think it's so important to share that here.
Absolutely.
So what advice do you have for executive coaches on how to introduce financial data to their members, say their peer groups or one-to-one, whether on how to track data, use of metrics, where would your mind go with that?
What I would do is find somebody in your network that is the business person first, that also is the CPA. And that is the person that I would bring in, and I'd book it as a very low-level discussion or low-stress discussion about this person just going to help us understand, read through some financial statements, tell us what they pick out of the items. And then even where I like to use cases that, you know who Sears are. We don't have to go any farther. We have that in common. You already knew things about Briggs and Stratton. Because you have that, then we can talk about the other parts of their financial statement. So if I was educating the group, I would try to take some commonality that everybody could relate to. If not, I would have them just talk about the individual's company if I was being their coach, and then I'd bring that person to meet with the other individual.
Okay. So looking back on your journey as a coach, what lesson have you learned recently that you wish you'd learned earlier on?
What I find easy to fall into as a trap is when we take a step back, you can see dysfunction in other people, in other companies. In my case, when you have the whole group that you're dealing with the coaching, I am also part of the group. And so it is possible that I don't see my own dysfunction at times or something that's going on because I'm involved with it.
That's very wise. So many times we're involved and we may even be tempted to use our knowledge to add to the group. But when we do that, it can create a form of bias.
Yes. Where
our conversation is overemphasized. Our points are taken too much credit when they might just be, here's the one idea, but you told me to do it.
Yes.
And also, I think when we add advice, especially without permission, we risk saving them from the journey of discovering their own solution that might even be a better fit for them.
Yes, agreed.
So do you have a why, something that gives you purpose or energy?
I think because of being with the Lutheran Social Services, when I put together my mission for Thorsten Consulting, I borrowed a lot from that, but it really talks about what I like to do. I improve people's lives and their businesses. If I'm in a position to do that for someone, that really makes my day. To have someone say, Jim, you made a difference. But believe it or not, as I've gone through the profiles, I am not a person that is driven by money. It's not something. I had someone try to incentivize. I won't go into the details, but someone the other day tried to incentivize me to do something. I said, you don't get it. That does absolutely nothing for me. That's not who I am. So where I can help somebody, when I do my speaking now, I was doing 70 live presentations per year prior to COVID. This year, I think I did, or 2020, I did 7 or 8 live presentations and probably about 40 to 45 virtual. So I did have a lot on the virtual. And when I get into this, I'm almost, it's like a religious fervor. I'm preaching, and I know what happens. I get into that zone, if you will. But I tell the people, if I don't get to your questions, if we don't have the time, connect on LinkedIn, and I'll spend the time with you on the phone. I'm not going to charge you for it. I mean, it's important to me that you get what you need out of the process. So I will extend myself so that I can help somebody. I know one of my sons, when we did all the rugby stuff, he would wonder why I would spend the time with some of the least potential players. And it was because I just thought, maybe I'm stepping in some other father's shoes here. I'm helping someone get to a spot in life that they're going to be a better man later on in life. That's worth my time. So that's what I really get interested in now, is how can I help someone? How can I help improve the business? And that's what makes it happen.
That reminds me, many people in coaching feel the call of coaching. They could make a lot more money somewhere else. And then, we all like to make money,
sure,
but there is something about this that when you're helping other people, you're lifting other people, you're raising them up, the low performers and the high performers, there's a lot of value there.
Yes. Well, and I even, coming out of the social services industry, I have looked at someone like myself, and I'll use the title that I'm a social worker for business people. That's what I look at some of those things that we do. We're there when they need us. We're helping them with difficult problems. We're helping them see around this stuff. So very, very similar to what you're talking about.
So let's shift the conversation here. I started to create a journal many years ago called my Book of Bests. Oh, there you go. You got your own journal there. And in my Book of Bests, I list my 10 best restaurants, 10 best vacations, 10 best days, different things. Just caused me to think about those peaks or the valleys where that life has handed me, because that's what I tend to remember, not the bland in between.
Right.
So thinking about the best, can you share with me the best day ever you've had as a coach?
Because of you saying the 10 best, I want to tack onto that and shift it just a little bit, if I may.
Sure.
I think so much depends on our outlook in life. So the best can be a series of different things, but I also believe that, the difficulties are the times when we can shine. So the image that came to mind right away, which I wanted to share, was we do a lot of fishing and hunting in northern Wisconsin. We have a small cabin up there. And one year we didn't get the dock out on time. So it was in November. I'm in my rubber waders in the water, and I have my 2 boys and my nephew, all similar age. They're not exactly excited that we're doing this at this point, but I'm the guy in the water. They're on the deck, so they're at the dock. So they're not going to have a hard time about it. And we just got to make sure I don't get hypothermia or something. And what happened, though, it started snowing on us. And you could see the boys got even a little bit more distraught. And I just said, hey, I want you to do this. I want you to put your head back. I want you to put your hands out. I want you to try to catch a snowflake on your tongue. I said, this may be the only time. and it probably will be, that you ever experience this. What do we learn from it? What's the value to it? So the 10 best for me is always trying to take whatever it is and what is my learnings out of the situation. So if I have a meeting and someone can say, I learned something, or that was helpful to me, all of those become part of those best days to me. And so I kind of sidestep it a little bit, but it gives you an idea of where I look at it. But I do like the 10 best. That's a great idea.
Thank you for your share. So questions are an important part of a coaching toolkit. What are some of those most powerful questions that you have ever asked as a coach? And do you have your favorites?
Yeah. When I get into the probing questions, one of my favorite ones, especially for coaching, is, may I offer you something? And the reason I like that one is when someone says, heck no, then I keep my mouth shut. But when someone opens up and says, sure, that doesn't mean they're agreeing with me, but it means I've gotten through the door and at least I can present the thought that's in my mind. So I think that's one of the most important ones. And then the other thing then is where I try to provoke the thought on the other person. Don't try to blend your conclusion in with your question, but what do you think about? And sometimes if the question is going to be really challenging, try to get the person into the third person looking at the situation. I remember one of the retreats we had for Vistage, and just like, you put together all these exercises, you want to make sure there's plenty of things to round out the day. And I was surprised. One of the questions for people to talk about was, who should be fired that hasn't been fired? I couldn't believe the activity that went on by that one. So when they looked at it that way, it was kind of that they just went ballistic. So I think when you look at this, even in the third party, what is the thing that you should be doing that you're not doing? Tell me the name of your most favorite counsel person that you have, someone that you trust implicitly. Okay. They give me that and I say, okay, what would that person say about the way you're running your business right now? And you can see the people actually change the way they're thinking about things. That would probably be my best answer, Severin.
I love all those questions. Your one, who should be fired today, reminds me of one. I had a very fast growing group, and everyone was trying to do, claiming 25% CAGR or more. Some of them were really throttling it up.
Wow.
And so, but there's not a lot of room for dead wood on the team. And we used to have this mantra, it's not a good meeting until someone gets fired. And people were like, whoa. But what it was accountability. It was like, who needs help? Who right now understands you can't move forward until you put the right position in place? You're lagging, you're holding on, thinking that somehow things will change. They often don't change. But they might get worse.
Yes.
So I was inspired. I love your questions. Those are rich. So we've talked a lot about success. Can you share with me a valuable failure that you've had in coaching and that's been a valuable lesson to you?
Oh, how many hours do we have?
Just pick one.
I can think of one person that I missed who they were. And the person was much more of an accounting profile. He was an engineer by trade, which is basically the same as an accountant. Stereo or generalizations, very similar to the accountant. And the person was just very, very particular about everything. And I am very general about everything. It's always been the way I've been. And I think what happened was this person went down a path that they started getting uncomfortable with what I'll call my flexibility, and they just couldn't operate that way. And I could not, I could not recognize that so that I could make a change. And I know you're aware of this as well, but we've been told that we create the groups. The groups kind of get created around our profiles, because if someone doesn't work out, we get rid of them. But even as you talked about accountability, I remember some of my members, as the, we have our peer groups of chairs, and they say, let's do more accountability. Let's have people check in on financial statements, on metrics. And my members were crystal clear. They were not there for that process. They could care less about that. They said, hey, this is our day to rejuvenate whatever. You start telling me to come in with my financial statements and telling me what my strategic plan is, I'm leaving the group. And maybe I've found people that were more similar to me, but I think it's when I've made mistakes on personalities, and that's been the biggest thing for me, Severin.
Can you just kind of summarize what you view or you observe as a participant in this coaching industry? How's it changing?
There weren't coaches a couple decades ago. There were people even railed at that term. Now we have everybody and their mother's first cousin have become coaches out there. I worry about the quality of the coaching that's being provided, and I worry about the representations that people make. I have one course that I offer to the CPAs that is actually coaching skills for CPAs, controllers, and CFOs. And I typically don't go out of my way to say, here I am, here's all the great things that I do. But when I start that course, I sit everybody down and I say, folks, this is something so important. I don't want you to think I've read about this in the books. At this point in my career, and I can't, 4,000, 5,000 coaching hours to CEOs. What we're going to do today is I'm going to take you through the things that work. And as you point out, where some of the failures have been in my own coaching experience, but you're getting it from someone who has been there and done that. And I worry that people in their mid-career that cannot find another successful position, they're knocking down 150, 200, they lose their job, they come to you, you can't find a really good position for them. And then somewhere they say, man, I'm kind of like Severin, I could coach too. And then what they do is they go out and hang out a shingle and think that this is just something that you go about and do. You can mess up a lot of people's lives in the process. And even when we give counsel to other people, I have to be respectful that what works for me may not work for you, or vice versa. My TEC chair that I loved, him and I saw the world totally different. The way he would attack problems was totally different from me. So I see people getting involved that I think they need to be a little bit more cautious. I do see the pricing pressure that you talk about. I'm happy that people are trying to make it more professional in terms of let's have some agreed upon standards, et cetera. I think one that falls way too short in all business lives that I have seen is confidentiality. I think people violate confidentiality way too often, and that bothers me tremendously.
I'd love to have another conversation sometime about this notion of confidentiality. That's a huge pet peeve for me.
Yeah.
What's in the group stays in the group. And I've had groups where nothing has ever come out. And I have joined other groups and I've had things leak out within 4 hours of something being said. I'm like, whoa, what happened there?
Yeah.
And you learn something about group norms such that unless I intentionally want to put something out to go to the universe, I won't contribute. And so you really have to create that safe environment.
Absolutely. Absolutely.
As you look back at your career, can you attribute a single experience, an attribute, or a skill that's made you a difference maker today?
What I have found interesting in the writings that I do for the AICPA, so again, if you accept the concept of a thought leader, in my world for the controllers and CFOs, I am that. And I don't mean that trying to be arrogant. But when I look at the stuff that I have assembled, and I talk about being that business person and being someone that is much more than the CFO or the controller, I have to lay that back at the feet of TEC and Vistage. I've shared something. I look at something I write and I say, wait, where did you learn that? I said, oh yeah, that was 2003. I learned that from this person. Where'd you learn? Oh, that was 2007. The business person that sits here today is different because of what I've learned in the Vistage and TEC.
So Clayton Christensen wrote a powerful book with the title, How Will You Measure Your Life? How will you measure your life?
I remember, I don't know if it's 10 years ago, 11 years ago, and it was Thanksgiving. And so our family, we were holding hands, saying a prayer before the meal. And before we started, and I will typically do this, I'll say something to everybody there. And I just said, kids, if you ever ask for where is all the great Lindell wealth, it's in your hands right now. This is it. This is everything that we have as of value. It's you guys. That's what's important to us. And no matter what you do in life, you're not going to see a bank statement on a tombstone. You're not going to any of those things. And it's the love and the things that we share together. So to know that I am successful in life will be that the kids go on and that they honor their families, they honor their commitments. They try to bring more to the world than they take out of it. And I would also like them to be forgiving and great learners. If they can achieve that alone, our lives will be successful. And I say that I met my bride of 40 years this July down at Platteville. And that's been a big support to the whole process as well. So I think that's what I will really do. And maybe having our Irish rock folk band play at Milwaukee's Irish Fest, the largest festival in the country. Add that one to the list and we're good to go.
There you go. That's nice. Well, first off, congratulations on nearly 40 years. That's
Thank you.
Quite an achievement. That's something to be very proud of.
Thank you.
So what is the question I have not asked you that would tell us more about you?
What you would do differently, probably.
What would you do differently?
I'm probably way too intense, Sev. I think early in my career, you know that joke about burning bridges. I think I went through my first 15, 20 years, and I think I carried a can of gasoline in one hand and the matches in the other. So it was easy for me to do those things. I think I needed better control on some of the things I said, the way maybe I treated people at times. Definitely more patient. I started job hopping before that was a term. I remember my dad spent 40 some years with the same company through like 3 or 4 buyouts, And I remember after I left 2 companies with just like 2 years at each of those. And he pulled me aside and he said, Lindells don't do this. And I said, Dad, it's a different world. But in retrospect, I also believe that's part of the ENFP versus the ISTJ. That was in there. And any time in my career when I've had difficulties, I can usually tie it back to I was doing something that I wasn't designed to do, and I didn't recognize that. This understanding didn't come to me till probably, the mid-90s, Sev. And that's a long time in life not to understand who you are. So I'm a very deep thinker, but I think I understand much better how I can use my skills and control them now. But that's what I do differently.
That was powerful. I've taken a similar journey. In the past, if somebody asked the question, what is the animal in the animal kingdom that is most like your personality? Yours in your younger days and yours today, what would they be?
Initially it would have to be the lion or the tiger. And now it would have to be, you think of some of the animals that are more loners. I can't give you a name for one of those, but the animal that, is very comfortable being off by themselves, that would be a better descriptor of me now.
So we're very similar. In my youth, I would have told you that I was most like the Bengal tiger.
There you go.
Ferocious when you needed to be, definitely king of the jungle, but the ability to understand, but definitely control all those other things so important.
Yeah.
And I've changed. The animal I most relate to today is the wise old owl.
There you go. Perfect.
And the one that can see, discern, understand, still has the ability to bring out the tiger if needs to be, but has realized that tiger doesn't always work for you sometimes.
That's right.
And isn't it interesting how we can shift in life from a phase and we can go through some understanding? And quite honestly, I don't know how we teach that to younger people until they experience some things on their own. Well, I have really enjoyed this time with you today.
Likewise.
There has been so much here. Can I just tell you a couple of things I heard?
Oh, please.
Okay. Well, let's go back to the questions. I love questions. To me, that's the fruits. That's the great stuff. Your questions. May I offer you something? The power of asking permission. What do you think about that? Or tell me more about your thinking on that. Or moving somebody to a third person so they can have that state, see it from a different perspective. Who should be fired that has not been yet fired? That will kick off a fire. And then name your most favored counselor, and then what would they say? That's powerful. Learnings. You have I could tell you are a very strong person. You got that, that Viking kind of background, and yet you have a humility about you. Oh, what is the right word for this? The word is meek. Now, the Trojan horse was showing meekness. It was mighty powerful, but its meekness was to be able to go when in control into battle and to know when to move forward or not. So it had all the strength, but it wasn't using it immediately. Mm-hmm. And I see that in you as a great strength. You have all this power, but you have learned through life experience, your own thinking, cognition, and just, I think your spirituality comes out, which is a sweet part of your personality, that you can be meek. It's okay to be humble. It's okay to be authentic. It's okay. And in fact, you can get charged up. It's wonderful to give. It's one of the reasons I put the podcast together, is to try to uplift and help other people. So it's been really fun. You just kind of renewed why I enjoy being with you. I think other people will see and hear that.
Oh, thank you. This is fun.
Thank you so much for your valuable time today and insights. For me, it's been rich. We learned about your why. We learned about your questions. We learned about your difference making. We saw the authentic you, and there is so much to like. I have been speaking today with guest coach Jim Lindell, who is a CPA, a CSP, CGMA, and has an MBA. Jim is an executive coach, a Vistage Chair, a TEC Chair for now some 19 years. He's a best-selling author, and he's written a book most recently, Controller as the Business Manager, and I highly recommend that's become part of your library. He is the owner of Thorsten Consulting Group from Wisconsin. You can reach Jim at thorstenconsulting.com, and I have Jim's webpage on the screen now for you to view. With each session of the podcast, I end with a quote or two for you to ponder, and today I have 3 short but powerful quotes for you. The first comes from Agnes Ripples. Things are as they are, and no amount of self-deception makes them otherwise. It can be very powerful, especially when we're thinking about numbers. And from the master of management, Deming, do you know that doing your best is not good enough? You have to know what to do, then do your best. And again, I think powerful, thinking about the numbers need to tell you. Let the data tell you where to go, and then do your best. And then lastly, from Peter Drucker, can't avoid saying this, one of my favorite quotes of all times, the days of the intuitive manager are numbered. So until next time, be your best self, seek to uplift others, be good and do good. You have been listening to Severin Sorensen and the Arete Coach Podcast, where we explore excellence and the art and science of executive coaching today.